So when you do have an environment that has lost that momentum, that has lost market participation or breadth, that it is running a little bit hot in terms of market sentiment, that's a higher risk environment. So it'd be more prone to those types of big drawdowns. And that's why we are more defensive right now in our recommendations.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Over this past weekend, the United States conducted an airstrike that appears to have destroyed Iran's most important nuclear facilities. The U.S. had been supporting Israel with defensive measures in its military campaign with Iran, but this marks the first offensive role America has taken in the conflict. So, what material impact will this have on markets, if any? To discuss, we're fortunate to welcome back to the program market technician and portfolio manager Katie Stockton, founder and managing partner of Fairlead Strategies. Katie, thanks so much for joining us today.
It's good to be back again, Adam.
Thank you, Katie. It is such a pleasure to have you back. Congratulations or condolences. I don't know. You drew the card of being the first person I interviewed after the U.S. Bombed Iran here. So we're recording this on Monday. And let's start there with just, hey, what impact do you think the U.S. participation now, active participation in the Israeli-Iran conflict might have on markets? And I'm asking this question to you on a day where I think everybody over the weekend was trying to bet how far down the markets were going to open and how far up oil was going to open. And in fact, we've seen pretty much the opposite.
We have, and it's confounding a lot of us. I was logging on yesterday and Sunday watching the futures and already kind of awestruck by the lack of a reaction from equity markets around the world. I believe even Israel's stock market is up, which is sort of, I don't know, curious as well. I would just expect more downside volatility to be unfolding in equity markets globally. But there is a real bid to the market, and it was there before the war too. So we've seen an incredible relief rally for the S&P 500 and the other major indices off of the April lows. But there's some real damage done from a technical perspective as of those April lows. We saw a lot of breakdowns at that time. And even though the rebound has been even explosive in some areas, we're not seeing breakouts, and we're not seeing necessarily massive improvement in our longer term indicators. So we do think that there's still some risk here. So we, on May 28th, moved to a bearish short-term bias, and it's been a little bit of exercise in frustration watching the markets here. It's waiting for them to respond to what we feel are pretty high conviction counter trend sell signals per our indicators. So we're watching, we're waiting. We don't have anything to counter the signals yet. So we're sticking to our bearish bias right now and recommending that folks are hedged. And I would say that the geopolitical risks around the conflict, of course, would warrant that as well. So not to say people go out and sell everything, but perhaps reduce exposure from a top-down perspective. That seems wise to us, and just position a little bit more conservatively than we were accustomed to 23 and 24, when it was time to obviously be exposed to tech and to the mega caps. Now I think it's time to look outside of those areas for opportunities, especially the more defensive sectors of the U.S. market.
All right. And I want to talk about those defensive sectors, because I was reading some recent reports that you guys have put out at Fairlead. But a lot I want to pick apart in there if we can. So let me ask you this first, just at a very high level. You used the word confounding, right? And that certainly applies to today. But I think it's not the first time I've heard that word this year. And let me just ask you this. Do you think that the market is, whatever it's pricing in right now, do you think it's pricing it in based upon some collective market logic? Or are the markets maybe broken in a way that they perhaps weren't in past years or decades? I've heard people argue that there's deformations to the markets these days, that they just don't behave the way that they used to. So I'm just curious if you have an opinion one way or the other on that.
Yeah, I mean, I would say that moves are maybe exacerbated by forces like the, ETFs, how many ETFs there are out there, passive ETFs that are just having to pile in at times, right? So I do think that moves are probably oversized relative to what they were before. But this level of volatility we didn't have, of course, in 23 or 24. So it is
Mhm.
sort of a new thing. And we always are a little cynical to say that things move in cycles, right? Global warming, for example, right? These are cycles that when you're in the midst of it, it feels, really intense, and then it changes, and then you kind of reflect back, right? So I don't think the market structure has changed meaningfully enough to suggest that this is just a market that can't go down, certainly. But it does, the reaction to the news is curious. I don't know that it means it's priced in necessarily. I think it could also just be a reflection of uncertainty, folks not knowing exactly, how to position, and also maybe at times just looking for the best of the worst, right? Looking for the place to, find relative performance, which has historically been the U.S. equity market. We are more inclined right now, though, to buy things like precious metals. We've been very bullish on gold. We recently, I think it was in early May, maybe, that we highlighted a breakout in platinum. Silver's
Hmm.
got a breakout. So that's more interesting to us, where we're seeing these positive technical catalysts. And we don't really have those catalysts as much in US equities, except maybe here and there from a bottom up perspective. We see some individual stocks that are acting well. What's a setup that's more interesting to us than the names or the indices that have run up so much are names that have actually been downtrending, because while counter trend exposure is higher risk just by the nature of it, when you get a downtrending opportunity, and you see the momentum shift, right, it can be a nice long-term bottom. And
Hmm.
of course, downtrending stocks have underperformed. We talked about Estee Lauder today as one example of that, where you wouldn't think that that's a great long-term trend. It's years in the making, on the downside, but there's enough signs of downside exhaustion from our indicators to suggest that it's turning the corner. And that's a little bit more exciting to us as an opportunity, something that might be at a better valuation, perhaps, certainly than the mega cap complex, which has really just seen a pretty massive run. The mega caps are still very, very much contributing to what I feel like is this underlying bid to the market. But now we're seeing some signs of exhaustion there too. A little bit of a crack, I'd say, in their leadership stronghold, that we think will manifest itself in something a little bit worse than what we've seen so far.
All right, and I do want to talk about that in a moment, because the Mag 7 is now, um, we've seen some weakness there. There are some companies that maybe aren't so magnificent anymore. Apple probably being a really good example, right? Okay, but let me ask you this, again, and just in terms of sort of the market's unsinkability here at this point in time. I mean, it is volatile. We definitely had March and April, but they bounced back extremely, as you said, right? Um, and I'm just wondering. Don't necessarily think this way, but I'm just wondering. Could it be that that the market is looking past everything and seeing brighter futures ahead? And so obviously what freaked out the markets in March and early April was the tariffs and the extremity of the tariffs that the Trump administration put on all these other countries. Um, uh, which was a surprise to the market. But I think as the market has digested it, you've had more people saying, okay, well, you know what? We think eventually the tariffs are probably going to end up being much lower. If we take the Trump administration at their word, they're going to strike all these trade deals, and we're probably going to have better trade relations than we did before. And the big, beautiful bill will likely pass in some shape or form, and we're going to get more deregulation. So are they already beginning to price out this future of higher economic growth as a result of these policies? And similarly, maybe the market is saying, I don't know, but maybe the market is saying, yeah, we're a little bit nervous about what just happened in the Middle East, but my goodness, if this is what it takes to bring Iran to heel, and they don't have the ability to project the disruption that they have in the Middle East, and maybe this opens the door to a lasting peace in the Middle East if Iran starts playing ball, or if the people there overthrow the Mullah regime, and then this starts becoming a partner for the US the way that like Saudi Arabia is. I mean, is the market maybe just pricing in the best case scenarios in these different?
Yeah, the word I used today here internally was hopeful. It's a very hopeful response, right? Hopeful that the tariffs will work out, hopeful that the big bill will work out, and obviously hopeful that we won't have a World War III. So it's a hopeful response without question, but it's one, the response does carry, sort of a fragility to it in that the headline risk that we used to be accustomed to for individual stocks is really now an issue for the overall market because with the tariff headlines that we're likely to ultimately receive, no one really knows. So I think when you come into these headlines, which hopefully don't get any worse, when you come into the headlines and you're with this kind of bullish sentiment behind the market, it's just more fragile. And you can measure that using the charts. So we measure it a couple of ways, but one way would be investor polls. There are services that go out there and say, are you bullish, you bearish? We also measure it using more transactional gauges like the volatility index or VIX. The VIX is looking at puts and calls and their relative premiums and saying, okay, well, are people hedging? Are they getting more nervous or less nervous? Things like junk bond demand can work their way into these answers. So you can look at these transactional indications of market sentiment. And right now we have what is a bullish reading. It's not extreme, but it recently was very close to an extreme level. So I don't know if that's enough to, lead to a pivot, but it does create a potential environment in which a negative headline will be very poorly received. Anything that dashes that hopefulness.
All right, and that's kind of what I was wondering here is you use the term hopeful. I'm wondering if maybe we could use the term like Pollyanna, that the market is just looking for the best case scenario in whatever is happening, which if it is doing that, then it puts itself at risk to say, oh, if the news winds change, they have to start repricing downwards because they were just being way too optimistic.
That's right. And I mean, it is hard to justify, and I'm not a fundamental analyst, but when you see NVIDIA up nearly 70% since April, it's a high risk entry point. Let's put it that way. When we see these rallies also start to lose momentum, you can see it in things like the 20-day moving averages or the MACD indicator. When they lose momentum, it just becomes even more fragile, right? So these are things that have happened and that drove our shift to a more bearish bias short term. The ideal situation to us would be that we do get a pullback, that it is actually pretty swift as opposed to orderly. I'd actually rather see a swift and sharp retracement because that's more likely something that will meet buyers sooner. It's going to be like something that's more characteristic of a bull cycle. Whereas the slow grind lower, I think, is the one that we need to worry about from a longer term perspective. It's that slow grind that is more characteristic of a bear cycle. And there are some indications from the longer term indicators as of really late 24, if we reference our DeMark indicators, which are they gauge trend exhaustion is probably the best way to describe them. We had some sell signals unfold in November and December on the monthly charts, and then we saw subsequent sell signals in our monthly MACDs. So there are some overarching risks that are a little bit longer term in their implications, maybe months, not years, but certainly through year end.
Okay. So I want to ask you about the technical damage that you said you saw back during April. Like if you have any specifics about that, but I guess in our way to that question, let me ask you this. There was a lot of debate, up until the week or two ago, where I think the market kind of made up its mind. But was March and April a just a correction in an otherwise intact bull market uptrend? Or was May, the violent May rebound, was that a bear market rally that is trying to suck as many people back into the markets as it can
That,
before
that
it
is
takes its
that
claws
is
out?
the question, isn't it?
Yeah,
Yeah. So
yeah.
I'll show you evidence to the former. And yet we are always going to be respectful of certain like changes to our indicators, right? So indicators are just factual. They're giving you a sense of what price is doing and whether it has momentum. So this is a long-term monthly chart of the S&P 500. And you can see that there is a secular uptrend. You can see that in a traditional fashion, looking at trend lines. You can see it in this cloud model that we use, a shaded model. So secular uptrend is still very much intact. But you can see we're in what I would call sort of a cyclical downturn potentially. So it's treating this, which is our swoon that started in Q1, as significant. So if you look at the monthly MACD here, that's a measure of price momentum, a trend following gauge, if you will. And then also this downturn back here is something that tends to see downside follow through. The closest comp that we have to the current setup would actually be, it's still relatively early 22. So if you look, here was a MACD sell signal that was April of 22. You got the downturn here in February of 22. So we're still potentially relatively early stages for this cycle. Perhaps this cycle is more of a range, a volatile range, than it is a bear cycle like 22. But we do think that the market's kind of pressed the reset button in a way, and needs to, sort of see valuations normalize, needs a little less uncertainty to get to the place where we feel we can just not look back, right? And, buy and hold again. So we're a little bit more trading oriented, I would say, in our positioning and our ideas, trying to leverage the short-term moves. We did capture the move off the April low. Leveraging those short-term moves can be hard, but it can also be lucrative, right? So trying to leverage the volatility as opposed to hide from it. But we do think it could end up, sort of resurfacing here on the downside.
Okay. And in a volatile market, the active management approach oftentimes delivers superior results because you can play those ups and downs, as you just said. So let me ask you this what I hear you saying is we are cautiously optimistic that the bull trend is going to remain intact over the year, but there's going to be a lot of zigs and zags on the way there, and we're going to be, trying to position ourselves accordingly. What would you need to see here? You said you haven't seen enough. I guess I'll go on the bull side first. You haven't seen enough yet to say, okay, it's time to go all in on the long side, that the long side's really winning out here. What would you need to see there to get more confident that, all right, we're gonna play it along more aggressively?
Yeah, and to be clear, I do think it'll take months. I don't think it's going to happen quickly. So we're just respecting that long-term loss of upside momentum for now, but within the context of the secular bull. So we're still in that mindset of ultimately adding exposure once we have more evidence that we have a longer-term low. And the way we measure that typically would be looking at our indicators, that same MACD indicator, the stochastic oscillator. These are all price-based tools. And it takes all the emotions out of it. It takes all the
Hmm.
headlines and everything, and just isolates what is actually the price action. So we take our indicators and we look for buy signals. We look for them to go from what have been recent sell signals to the opposite of the way they look right now. So we want to see either MACD buy signals, stochastic upturns from oversold or maybe nearly oversold. Breakouts would be good too. If we could see some breakouts, that would suggest perhaps that we're being too bearish. So we have a collection of things that we'd like to see. Sentiment and breadth. So those are the market internal measures. We'd also like to see them in a position where right now I'd say breadth is sort of positively correlated to the S&P. It has that same loss of long-term upside momentum. And then just very recently, we use the percentage of stocks above their 50-day moving averages hit
Hmm.
80%, right? So you can look at that as sort of an overbought, oversold metric of its own. So when you have that short-term overbought reading within a longer-term setup that's losing momentum, that's not great. We want to see something maybe out of these market internal measures that's a little bit more compelling. And as you know, I mean, the market lows do not occur typically when sentiment is very bullish, right?
Right.
So, we are afraid, unfortunately, that we'll get to that place sometime. Maybe it's before year end, but if not before year end, then I would guess early 2026, based on the implications from the indicators that we have. So those are the types of things we're looking for. Those indicators that are longer term in nature to flash buy signals. There, I won't bore you with the exact metrics or parameters that we're using. That's all in our research, though, if you're interested. But it's just a sort of an opposing setup to what we have right now, where things look pretty extended.
Got it. Okay. So again, you expect your default assumption, it sounds like, is chop for the next couple of months. Um, without having more data yet, you think that the bias may trend towards to the upside after the chop. And I think right now, where we are chop wise, you think we're more likely to head downwards than upwards for the reasons you've mentioned. What would what would it take for you to start saying, gosh, you know what? I actually think may have been a bear market rally and this thing is going materially lower.
Yeah, I mean, we do have some evidence that it could go materially lower, but even the April low, I would argue, is that. So you could go down a whole lot without even actually making a lower low relative to April. So it
Hmm.
just depends on your definition of what material is, right? So we have some evidence that even the April lows could be taken out just by the nature of these sell signals being somewhat early. But typically, when these long-term entry points unfold, we don't see the market spend much time there, and we often see correlations go very high. So just about everything participates on the downside, and then everything kind of gets washed out very close to the same day. Yeah. So I think the top-down analysis is really, really important right now, where you just want to make sure that you have the major indices on your side, and it has been on the bullish side recently, but we fear that that's going to sort of quickly change here. So we're just, watching and waiting, either watching for a positive catalyst to suggest that we're being too bearish, or watching and waiting for that, downdraft to give us an oversold reading that looks compelling. We don't have the ability to predict when or where that happens, of course, but we do have sort of the ability to use those indicators to manage risk, to say, okay, well, we had this massive run up, Nvidia up 70%, and yet it still has a lousy long-term momentum indication. So maybe let's, take some profits here, right?
Hmm.
And and revisit lower. So we think of it within the context of the broader market.
Okay. And given your current market outlook like that, which, if I heard correctly, suggests that short-term risk is to the downside. Um, are you holding more cash than normal to deploy it at better valuations if indeed they emerge?
Well, that's what our recommendation would be to the advisors that often use our research. So we are a portfolio manager and also a research provider. And in the research, that's the type of thing that we'll write about, to have dry powder to put to work when we do have evidence of a longer term low. So that's certainly been a recommendation of ours, really, since we started to see the sell signals unfold late last year, to suggest that, upside might be limited. Let's, look for better entries. And if they're shorter term, they can have, of course, taken advantage of the volatility of late, right? But in our portfolio, which is an ETF called the Fairlead Tactical Sector ETF, or TACK, in that portfolio, we have moved to what I would consider to be about 25% risk off position. So we still have substantial equity market exposure. That exposure does lean defensive on the sector front, however, and also, the risk off pieces include sort of a short-term treasury position, a long-term treasury position, and a gold position, and a very small slice of cash. So that's where we stand presently. And I certainly wouldn't be surprised to move to a bigger sort of risk-off position before this cycle ends. We just listen to our models to sort of warrant that kind of repositioning. And I wouldn't anticipate it to happen right away unless something really does crack here short term. But as you've heard, we think that could happen. Maybe it's not before month end, but July could be volatile.
Okay. All right. By the way, this is super uh, valued and appreciated granularity that you're sharing with us, Katie.
Of
So
course,
thank you.
I'm happy to.
All right. So I want to talk about the opportunities that you think may lie ahead here for investors. You talked about the defensive sectors. Um, uh, are there? You just sort of told us your risk-off assets, which are largely treasuries and gold. What other sectors would you put in the defensive camp?
So we would say, like, I think your head goes straight away to consumer staples, and that was almost along the lines of that Estee Lauder idea that we put out recently, where if you look at the ratios of these sectors using like a sector ETF, perhaps versus the S&P, you'll see that the defensive sectors have come down and almost like sort of looked like a long-term base breakout, like or a long-term turnaround. It has a
Mhm.
little bit of that shape to it outside of healthcare. So we've been intrigued by that shift. It's manifested itself in our relative strength work, certainly from a long-term perspective. And then, after these sort of new uptrends emerged, favoring outperformance by the defensive sectors like consumer staples, we got this big correction in the ratios. So what that means is that consumer staples off of the April low haven't done as well, right? So it
Mhm.
doesn't mean they're breaking down in absolute terms, of course, but they've underperformed.
They didn't shoot the moon the way that, say,
No, no,
AI
they
stocks
didn't
did.
pull
Yeah.
it in NVIDIA. So we have this place where, they still have support levels intact in absolute terms in general. And yet the ratios are so oversold that they're flashing these counter trend indications that are short term in nature to suggest that we'll see that defensive sector rotation resurface here relatively soon. It could occur not only to the benefit of consumer staples, but also real estate or REITs tend to do better in a weaker tape. We also do see it in healthcare, but maybe not necessarily broad healthcare. It's, sort of sections of healthcare. And we feel like the utilities as well, of course, would be a more defensive leaning sector. So these are the sectors that we're most intrigued by right now. We're intrigued, of course, also by energy, given this momentum that we've seen shift behind crude oil. But that probably isn't going to be enough, I would say, to
Mhm.
warrant a new position in our fund because it's more of like what we're looking at as a short term or counter trend move
Yeah.
until
And
it
are you
kind of
skeptical that it's so tied to the Middle East action that if things quiet down there, oil price comes down again?
Yeah, and I think if you think about these long-term indicators that we're using, their design is to reduce the noise. So they're actually going to give you like later implications or indications of turnarounds. So they're not going to capture the absolute low or the peak, but they'll help you to know if it's a significant enough low or peak to warrant some repositioning, right? So it won't capture that, V bottom perhaps. But it will give you enough evidence that, okay, well, that V bottom is the start of something that's meaningful as opposed to just a counter trend move. And we don't have evidence of that necessarily yet from energy. It could certainly go that way. And we just trust those long-term indicators to, show us when it's a little bit safer, right? A safer entry point. So it treats, I'd say, corrections much differently than actual cycles, right? So the
Mhm.
corrections are, opposing moves within cycles, and they're usually, I would say, pretty short-lived, both on the upside and downside, mind you. Weeks, not months, typically.
Yeah. Yeah. Which is why, and I try to remind people of this, if you're bearish, um, you know, bears have to get their timing right because they usually don't have they don't have a very wide window to be right on when things go their way.
Yeah, it's a
Uh,
good point. I mean, when you think about the volatility index or VIX, which is often used for hedging purposes, I always caution people, they're really difficult to capture those spikes in the VIX because that's when, of course, the market's going down and when you want to be hedged. But
mhm.
to time that perfectly is so difficult because the moves are often very, very swift. The first move off of a low that, or off of a high. And you have to be pretty nimble to be able to, I'd say, leverage that. And to your point on the downside, I mean, if you're shorting stocks, you're generally fighting the trend if you look back over history. So you
Yeah.
have to be at least aware of that and always manage risk. And that's why when we put out short ideas, which we often do, we always have sort of a level in mind over which this is not, valid anymore.
Mhm. All right. So this list of these defensive sectors that you've listed out here, um, in the current market environment, are you shifting more capital towards those sectors, or is this like a shopping list scenario where you're saying, I'd love to buy these things, but I'd like to buy them at better values, and if we get the downward motion that we want in the markets, we'll opportunistically buy in here as we hit our valuation targets?
Yeah, so we for the ETF itself, I mean, we'll certainly try to help people time shorter term entries and exits. Just like now, we're saying that we feel there's a short term, at least relative entry in these more defensive sectors. But in the longer term ETF, we're already there. We've already seen a shift in our fund exposure. That includes staples, utilities, and REITs. We do not have healthcare because it hasn't shown us enough of a momentum shift to warrant that shift. But we have sort of morphed into that more risk off type of position already because of that first, sort of show of outperformance in part. And also for the fact that they generally still have maintained their momentum, even though they haven't done a whole heck of a lot recently. So that's the way we're thinking. And, we always have to be clear as to whether we're talking about, an absolute move or something that's just more for relative performance. We have
Mhm.
clients who just want to make money. And then we have clients who are advisors who can't, justify going down to a certain exposure because they need to maintain their positions. So we're helping them in a different way, perhaps, right? Where we are looking for relative performance at times to help them through it.
Yeah, yeah. And for stocks like these, is it sort of a double barrel where if the general markets weaken the way that you think, these stocks to a certain percent have already kind of pre-corrected, and like you said, you're seeing a lot of them are kind of in the recovery phase. So either they won't correct as much as the markets, or relative performance will do well, or maybe they'll even absolute performance might even be positive because they're coming out. So you've got that, which is basically them just sort of stepping into their more true value. But then after that, when the market generally recovers and let's say the bull trend resumes, maybe that lifts all ships, and so you get kind of two bites at the same apple.
Yeah, that's right. So, and this is, I'd say, the case to be made for dynamic positioning, right? To kind of morph with the market's trends. And that's ideally what we're trying to do is to capture, to sort of protect on the downside, right? And then of course leverage the upside in a meaningful way. So it was up until just a few months ago that we had 100% equity exposure. And, that's where we, expect to see the fund most of the time. And, when we have this sort of morph into the risk off categories, we wouldn't expect it to last very long. We had it happen over the course of the model. It was 3 times that we went fully risk off. And I'm quite sure you could guess which environments those were, the 2008 type of environments. Over time that's certainly helped to reduce exposure in those, environments. And yet also we're aiming to limit drawdowns during big corrections too. So
Yeah.
even if this just was a big correction, we were able to contribute to relative performance throughout it because of that more defensive positioning. And that's what we think we're about, sort of on the brink of it, again. So what we want to see from our ETF TAC is that when the S&P loses 15%, we're maybe losing single digits and have a higher bar to recover from, because that's really meaningful long term when you sort of add it up and look at total return. And then you to boot can look at the risk reward sort of profile and the risk metrics that come with portfolios. And you can see that not only you're running at a lower correlation with these diversified strategies to the S&P, so you're not carrying certainly as much mega cap heavy exposure, for example. And you can do this, sort of lower beta as well. So less volatility relative to the benchmark type of thing. So
Mhm.
those are attractive strategies, especially in these environments that are choppier, that are more of like a down cycle. And yet to have that dynamic trigger to go back to the full equity exposure when the market warrants it, I think is also very important because you don't want to just run low beta all the time.
Right.
Yeah. So the catch is we have equal weight positions in the sectors. So that's by design. We want to have a lower correlation for one, but it will hurt the TAC ETF when technology is the biggest outperformer. So when the tape does get back to, firing on all cylinders, I do feel like, our recommendation generally is to hold the core type of exposure, go ahead and stay with those conservative positions because you want to have some exposure to the other sectors. But then it's usually wise to build around that higher beta exposure. So exposure typically through technology or growth stocks to sort of supplement in a stronger tape.
Okay. Did your model indicate that folks should do that coming out of the April lows?
Oh yeah. So well, no, that was a little bit too short term, I would say. So it
Yeah.
wouldn't have responded to that kind of, even though we think it's meaningful, it was responding to the longer term indicators. It wouldn't have repositioned, off of the April low. It was just too fast that it unfolded. It's so fast that it didn't impact the monthly gauges in a meaningfully negative or positive way. We had already seen some deterioration. So that's something that we focus more on in our research. We believe in long-term investing, but we also acknowledge and realize that people are always looking for ways to manage risks, for better entries and exits and what have you. So we also focus in the research more short term, and that will help people do just that. So we kind of supplement our investing style with this shorter term work, and always looking for opportunities, and there always are those. Sometimes you have to get creative is what I've been saying.
Hmm.
We found that breakout in platinum for one was not something that's always on everyone's radar, but kind of interesting nonetheless. Uranium people are talking about. Maybe that's not the right place to be right now necessarily, but with all that's going on in the world. But even still, to get a little bit more creative in the positioning, and we have so many products out there that we can use to do that now with the thematic ETFs, with international exposure. International has done a lot better this year than we've seen in a long time in relative strength terms. So it's not to say that that will be sustained. In fact, we think short term it's pretty vulnerable, but longer term, I'm intrigued by that. So there's always something to take advantage of, I would say.
All right. And we'll talk as we wrap up about how folks can follow your work. And I know that you guys have a relatively new Substack out in the world that folks can subscribe to and and figure out, how to best engage with all the different services that you guys offer. Um, okay, so let me ask you this. So you're a market technician, Katie, and as you said, you really let the model tell you guys what to do based upon all the indicators that you've been referencing. Um, how tough is it to do that in a year like this one, where the number of, I hate to use this word, but the number of news bombs that we get on a weekly, if not daily basis, sometimes hourly basis, that spin the market in one direction or the other. It feels like that would generate a lot of noise amidst the signal that your models, are generally follow. So is this a particularly difficult year for your type of approach, given that, or does that just create more volatility, which creates more opportunity for you?
Yeah, I'd say a little of both. I mean, it's a difficult year, maybe in the same way that perhaps like a 2018 corrective phase would have been. It's a difficult year for the market and a difficult year therein for investors, I think, to leverage in a good, sort of way that they feel is safe, like they're not taking too much risk. So it's just different though. And the impact on the indicators, there may be more whipsaws. We haven't really seen that from the market yet. But that could happen. in like a very choppy type of tape. But the indicators by design are there to take out your biases. They're there to tell you if it's a significant shift that we're seeing. And usually they're smoothing price action, right? So they're taking maybe moving averages of price, and that becomes the basis for these technical indicators. So they're eliminating the noise that can come with those headlines. So we actually feel like it's been pretty reliable from a technical perspective. The indicator shifted positive, by the third week of April, which was good, more short term. And now we have, of course, a shift that we're respecting in the opposite direction. So we feel like the indicators have guided us, quite well throughout this so far. That could change. We hope it doesn't. But just like you said, Adam, I mean, we're sort of listening to the market in a way. We're reporting what we're seeing, but we're not letting our sort of emotional judgment cloud the picture, right? It's really sort of math to us.
Yeah, and one last question on that, and maybe there's a slight difference between the portfolio management and the research side of things, but let's take something like what just happened this weekend. Um, do you guys literally not take that into account until you see whatever impact it has in the market data? Or do you say, okay, look, given that development, we think this, and this are most likely to happen next, and we want to position somewhat for that?
I'd say the former is probably more accurate, but with nuances to it, in that we do not try to understand necessarily the macro data or the headlines or the geopolitical risks in a way that the next strategist might. So it's not really our focus. It's not lost on us that these things are incredibly important. So I think the best way to think about it is that the charts are going to tell you what, and you have to go elsewhere to find out why, right? So we're not going to get the answer from the charts as to why something's happening. And like any other form of analysis, just like fundamentals, we know what the drivers of the trends are, and they are typically either for like individual stocks would be a good earnings trend or cash flow. Perhaps on the macro front, looking at the major indices, it will be rate cuts are most important, whatever it may be. We are very mindful of those things, but we still care most about the market's reaction, because all of that information that came over the weekend and comes at us all, constantly, really. Um, that's boils down into decisions, right? It boils down into buy and sell decisions for these big firms that can, really influence markets. So we want to see what happens, of course, afterwards. Sometimes, just like all of us, we'll get caught in some kind of gap down or gap up. You just miss it. You just miss that reaction. And that's just, I guess, a casualty of investing in general. So we can't predict every gap-based reaction. But we can certainly decide whether that gap is a meaningful shift in the other direction, right? So we can, again, leverage the moves in a way that I think is a little bit harder if you're just focused on the emotional takeaway from the news.
Okay. I'm going to pull an analogy from a previous Gulf War player. So Donald Rumsfeld, former Secretary of Defense, said, "You don't go to war with the army you wish you had. You go to the war with the army you got," right? And um, a number of the people I talk with on this program regularly will say similar things about the markets. Is it's like, hey, yeah, the market should do lots of things, based upon our analysis, but at the end of the day, we got to trade the market that is, right? And it seems like that is your focus, which is I'm not even going to worry about the why. I'm just going to deal with the markets we got.
That's exactly right. So it's all trend following. And if there's a reactive nature to it, that's just all part of it, and that's okay. Especially with earnings reactions, we're not ones to want to step in front of that position typically the day before an earnings report is released. We
Mhm.
don't we don't add value in that type of environment where there's an impending headline that we have no idea what it's going to look like, right? But where we can add value is in determining, where there's greater risk, right? By identifying key levels like support and resistance levels. We can identify trends that are changing over different time horizons, short, intermediate, long term. So these are great ways, and to help investors, I think, navigate volatility and also serves as I'd say like the ultimate sort of complement to everything else that you're citing. The understanding of the macro environment, the understanding of the politics, perhaps. So that can be sort of taken hand in hand with the charts, and I think that's where you get the most powerful takeaway when you have a sort of a well-rounded view. And the charts will always be there to keep you honest, right? Because they're often binary, these indicators in their takeaway. So they'll say, okay, well, is it oversold? Does it have an upturn? Yes or no? And it's sometimes a little harder to get to that easy conclusion when you're trying to digest all that news that's out there.
Yeah, well, look, another market axiom is the trend is your friend, and basically, you guys are experts on the trend, right? Is the trend intact? Is the trend looking like it's about to change? Whatever. And so, the very important trend, you guys, have a great finger on the pulse of that. And if I took good notes here, the what you see most likely to happen here in the near term is that the current market momentum is looking tired. More likely markets in general to head to the downside from here than the upside. You've said this is a time to maybe put in some hedges, build dry powder, position yourself defensively. You gave us a number of defensive sectors to look into. One area that you said you're actually bullish on right now in this market is the precious metals. You talked about the recent breakouts we've seen in gold and silver and platinum. Gold obviously has done very well this year as well. The mining stocks have really finally started to show life this year. So can you briefly tell us why you're bullish on this full sector in general and what you expect it to do from here?
Yeah, I mean, listen, we love long-term uptrends, right? So if you look at gold, it's one of few assets that has the long-term uptrend that hasn't lost momentum to a very significant degree. So that's why we're favoring gold very simply, just from a trend following perspective. It's a long-term uptrend with good momentum. And ideally, a portfolio of anything, right, will have mostly long-term uptrends. There should always be like supplemental positions, opportunistic ones that are adding exposure to perhaps that downtrending stock that looks to have found its bottom. But the vast majority, I think, of a portfolio ideally is in a long-term uptrend supported by longer-term momentum gauges. So that's the case for gold. And then we're always looking for what I would call positive technical catalysts, and for idea generation, and also to understand where there's, I guess, opportunity. That just puts more, I guess, probabilities in your favor. So silver having cleared an intermediate term resistance level was a nice sort of technical catalyst to highlight to folks. Platinum had broken out from what it was a kind of multi-year triangle formation. We love these triangle patterns. They show a range giving way to an actual trend. And so these are things that we're always looking out for. The other ways we can find catalysts are by just simply looking at the indicators flipping from buy signals to sell signals or back and forth. So breakouts, breakdowns, buy, sell signals, those can all be actionable, and you just have to keep the time frame in mind.
Okay. What do you think about historic relationships and ratios? For example, like the gold silver ratio, right? Which is I'm doing this from memory here, but I want to say maybe it's historic average over the past 15 years or so has been maybe like 70, but it's gotten stretched up to near 100 recently. Do you play the reversion to the mean on things like that?
I would say not as like from a statistical perspective, like not using historical correlations, because we have found that those correlations can break up pretty dramatically, especially over shorter term timeframes. So we're not ones to rely on those correlations in short term positioning necessarily, but we analyze the ratios in the same way that we're analyzing price. And that's one of the benefits of what we're doing here with these technical indicators. We can look at the ratio, say, of the healthcare sector to the S&P 500 or of Bitcoin to Ethereum. We can see opportunities there
Mhm.
using the indicators.
Sorry to interrupt, but how about like just commodities to equities to the S&P,
Right,
right?
right. So, and the cautionary sort of advice there is to make sure you know the composure of what you're looking at. So sometimes if you take a broad-based commodity benchmark, you realize later that it has 60% crude oil exposure, right? So to know exactly what you're looking at, but definitely seeing some points of interest, of course, there, especially with the precious metals, and now more recently with some of the energy complex signs of life in that relative performance versus equities. It gets pretty interesting. We also often compare, the S&P 500 to treasuries and look for opportunities. And as you would guess, just like these defensive sectors of the equity market, we have a big correction that we've seen in the likes of maybe the TLT ETF versus
Hmm.
the spiders. And you can see that correction now is showing some signs of downside exhaustion short term. So we'll take our indicators, put them over the ratio, and try to take advantage of those types of relative opportunities. Ideally, they are in the way of historical correlations and trends. But there's, those we're a little cynical about that too, in that we don't necessarily rely on that because they can really break up at times. So we use it as sort of in the same way that we're using maybe seasonality, where it's an input and a good to know, but won't necessarily drive our decision making.
Okay. Does that make you think that exhaustion of the downtrend in TLT, does that make you think then that bond yields are more likely to start going back down again?
I would say not necessarily. We are very neutral on yields right now. We actually think maybe it's not until 2026 that we'll see them break out to the upside. For now, though, that relative performance could even just come by the nature of TLT being flat and the equity market going down.
Okay.
Right. That I think is a little bit more of a likely scenario. We've been making a whole lot of noise around Treasury yields just in general lately, but the directional bias has been overall very, very much sideways. And so, every day it's something different to explain the big up move or the big down move. But there's been enough of those that you can just see a tug of war in yields. So,
Right. And it
um,
largely has ping pong just between 4 and 4.5. I mean, it's
that's
not.
exactly right. Yeah. So you have no technical catalyst there for the breakout yet. You don't have a breakdown. So there's nothing to suggest that it's going to move immediately out of this range. But if anything, we think longer term yields do actually move higher, and then it's just a matter of, okay, how is that influencing the Treasury market in terms of total return versus equities?
Yeah. And I got to ask, so why do you expect yields to go higher in the
So
longer
simply, again, those
term?
same long-term indicators. If you look at the monthly chart of 10-year yields, you'll see what I think is actually a secular shift. So we reversed a multi-decade downtrend channel in the early 20s here, so just a few years ago. And with that advance, the very long-term indicators did shift to the upside to suggest that now we're in this mode of making higher lows and higher highs over the next maybe few decades even. So we're going to, I think, get accustomed to an environment in which we are expecting generally higher yields given that trend shift. So that's part of it. That's working in the background, but the indicators have actually pointed sideways to lower more recently within the context of this range, which we're seeing as sort of a break in that uptrend, right? We're seeing the cyclical down move.
Right. But you see that as just a short term.
Yeah, I don't know. It depends on how you define short term, but I would say maybe it lasts, through year end. There's certainly
Right.
no rush to break out, but the indicators are very gradually showing. I don't want to say improvement because people don't necessarily want to see things go higher in terms of yields, but we're seeing these upticks in the long term gauges to suggest that there is actually an underlying shift going on, meaning that the range, or if you want to call it a down cycle, is sort of losing a little hold.
Okay. So bad news for President Trump and Secretary Bessent that they're just going to have this headwind, you think, in trying to get those borrowing costs down for the U.S.
Well, yeah, we
Obviously, I
hope
guess that
that
would
for
would
sure.
would kind of be a headwind, TBD, its level of intensity, but just on equities in general, right? I mean, it's a higher bond yields are a drag on the economy and make it harder for companies to be profitable.
Yeah, and I mean, but arguably they're also a reflection of a stronger economy, right? So you can look at it a couple different ways. I would just say, as important as the direction, the directional bias is probably the level, right?
Hmm.
So it's not just which way are they going; it's more like where are they and how much is that impacting things. So the upper boundary of the range that we're watching is around 474 on the 10-year. And above that, you're probably looking at an objective between 5 and 5.25. I'm not a macro strategist, so I don't know how 5 or 5.25 would impact the economy. That would be, where you want to use both disciplines, right, to have a good understanding. But I wouldn't, position for that unless we have a technical catalyst to support it.
To support it. But it sounds like you wouldn't be shocked if at some point in 2026 we had a 5 handle on the 10-year.
Yeah, that's fair to say.
Okay. All right. Last question on gold, and then we'll just wrap this up. So gold and silver to a lesser extent, people can look at the 15-year chart of gold and say, oh my God, this is the world's biggest cup and handle, right? And then it seemed to break out. Do you, I don't know if that's too simplistic from a technical standpoint, but does that have weight to you, that
I mean,
formation?
yeah, when we see those formations, I think they're pretty meaningful. And in fact, we saw one also in Microsoft, I believe last year. So we do keep our eyes out for these types of setups. I think it's sort of old news, unfortunately, for gold. I'm going to show you the chart here. But that's okay. It's still got the good momentum, right? The catalyst of that cup and handle breakout is already in the past. So here's maybe what you're talking about, sort of that range, but arguably down cycle for a year or two. And then the breakout from that range. That was a big deal. And it was obviously something that generated upside follow through. So we do like to look for those types of cup and handle formations. And anything that, again, gives you like a technical catalyst to act upon. This is the good example of Microsoft, right? Where you had a sort of a rounded basing phase. There's your cup, and here's your handle. It's a little bit cleaner, perhaps, than gold. And with the breakout, that ultimately saw good upside follow through.
If you can, if this is dynamic, go back to the gold chart for a second.
Mhm.
And if you can change the time sequence to start, say, in like 2009.
Yeah, I think I can do that fairly quickly here. And just to always, I'd say, acknowledge the time frame over which that we're identifying these trends. To if you can be a long-term investor, I think it's the way to go. So you don't get too stressed out by all the short-term swings, right? So if we were to pull this one back, here's our 2009 period. So
Okay, yeah.
here you may be
So
talking about this cup and handle.
exactly,
Oh,
yeah.
I
That
see.
was the cup. It was like this, almost decade-long cup.
Yeah, so it's funny because in our work we always look for so breakouts to be confirmed, and this was not a real breakout, but you didn't have the cup at that point. But here would have been your breakout. So that breakout from the cup and handle would have been the first two monthly closes above the resistance, and that would have been in April of 23. Certainly a good time to add exposure. But ideally, we are also able to, take advantage of this type of environment, right? So maybe it just means we're more heavily exposed equities. But any kind of trending environment, the charts can help you find opportunities in that context. So we're not afraid of trying to, put the downtrends on our side as well. We've had downtrends this year in semiconductors and even some drawn back to early last year. So we're relying on semiconductors to help us also time that long-term entry to suggest that once they're mostly long-term oversold already, which is not the case for the major indices. So we think that they may be the primary source of leadership and the sort of first hint at once we have that longer term low established. So we have sort of nuanced ways of viewing some of the downtrending areas.
Got it. Meaning, it shouldn't surprise us if when you think a durable low has been hit at some point this year, that you guys say time to go into semis.
Yeah, I think that would probably be one of the first places we'd go, just by the nature of them being oversold from a long-term perspective, and also generally higher beta, and people go straight back to tech. It's just the way it
Yeah.
goes. They are most interested, we found, in investing in technology companies, and it's an
Mhm.
exciting space, no doubt about it.
Yeah, well, and there is a lot of promise there. And semis, I know you don't think macro. You look at the data, but there's a lot of capital going into the semi space right now domestically.
Yes.
Well, really all over the world, but certainly domestically. I hate to ask you to bring up a chart again, but I'll get shot if I don't ask you this because I asked you about the gold cup and handle. Can you pull up silver's chart and just tell us what you think it's telling you? Because the way in which other folks who've appeared in this channel have looked at it is that it looks a lot like gold's cup and handle, except the breakout is perhaps only just starting.
Yeah. So yeah, I guess you could argue a cup and handle has to follow a proper downtrend. So you could argue perhaps that this is a sort of the cup and handle. I don't know how far back you're going on this one, but it
No,
has a
it's
nice,
exactly it. It's sort of
yeah.
same time frame as gold. Yeah.
Yeah, it has a good shape to it. I think that's kind of the takeaway here too. We like to use this cloud model. I like to see things generally above the cloud. I like those positive catalysts. The catalyst here to me is a little bit more of an intermediate term one. So we saw this is if we zoom into the weekly chart, gold clear this former resistance, which was twice tested, confirm the breakout there, and that acts as that positive technical catalyst intermediate term.
Hmm.
Shorter term, it's actually a little overextended, but that's okay. We can kind of live through that, knowing that we just don't have any sell signals here in our longer term indicators. So the stochastics, the MACDs, our DeMark indicators, there's no major resistance nearby. We even got above some longer term highs if we want to go way back, which sometimes we have to admit that the market's memory probably just isn't that long. But even still, it's good to see levels cleared.
Okay, so it sounds like what I'm taking from you is things look pretty good right now.
Yeah, and a lack of sell signals is a good thing in this tape.
All right, fantastic. Well, there's a lot of precious metals investors who are watching this video, Katie, who I think you gave them a little wind at their sails today. So
Good.
thank you.
I hope I can. Yeah.
All right. Well, look, this has been a fantastic conversation, and Katie, I very much appreciate both the process by which you and the Fairlead team do your work, but I very much appreciate your generosity in being as granular as you are and just sort of sharing, what you guys are currently thinking and what you're recommending to your clients. So, very important question for people that have enjoyed this conversation and would like to follow you in your work in between now and the next time you come on this channel. Where should they go?
Thank you, Adam, for saying that too. And we're pretty open source over here. So I think anyone who subscribes to our research gets to know our methodology really very well. And then they can leverage it themselves, right? And so we do publish research, and we have different levels of service where some is just like a newsletter, some is more consulting, some is very high touch project work. So that's our primary business, is this research service. The place to learn about it is on our website. So on fairleadstrategies.com. Anyone is welcome to take a 1 month free trial of the research, and it gives them exposure to exactly what we're doing, what we're putting in print. And it includes, I'd say, multiple reports covering all asset classes. So we write on just about everything, and it's very chart heavy. So anybody who is a visual person, I think, would really appreciate it. So the website's the first place to go, but then they can also find us at, Fairlead Funds is the information about the TAC ETF. We're on Twitter. We have LinkedIn, so they can find us pretty easily online.
All right. And I think you have a Substack too, correct?
We do have a Substack. So the Substack we treat as either a standalone subscription service, which is just for idea generation, or it comes free with our research. And the Substack is our forum for presenting individual stock ideas, typically once a week, that we just think hold some, sort of opportunity from a technical perspective, whether it's long or short. And we try to go outside of the S&P 500, which is where we're typically focusing in the research. We try to get a little bit more creative, perhaps maybe small to mid caps or different, thematic areas that we wouldn't touch on in our regular day job. So it's a great place if people are just, really interested in trying to leverage technical trends.
All right. And off the top of your head, do you know the URL for the Substack?
No, but it's
Don't worry
called
about it.
Fairlead Strategies Idea Generator. Hopefully
All right.
people can find
Don't
it.
worry. I will find it. And for that and the other assets you mentioned there, resources you mentioned there, Katie. I will
Thank
put up
you.
the URLs on the screen so folks know exactly where to go. Folks, the links will be in the description below this video too, so you can get to any of those with one
Appreciate it.
click. All right, Katie, thanks so much. Bear with me 1 second. I got about 30 seconds worth of housekeeping, and I want to give you the last word.
Of course.
Folks, if you enjoyed this conversation with Katie, please let her know by hitting the like button and then clicking on the subscribe button below. Um, if you, want to get a good sense for where the markets are likely headed and benefit from Katie and her team's work, obviously go to any of those resources and sign up for Fairlead Strategies. If you are looking for something, more professional guidance, then consider, well, I think most people, if you're DIY, resources like Katie's are great, a DIY investor. A lot of people, and I know a lot of people watching this video, you're trying to be the best steward of your capital, but you got a life, you got your work, you got your family, et cetera. And in those cases, it can be really helpful to benefit from the guidance of a good professional financial advisor who can take a lot of Katie's ideas and then tell them how to, apply them to your specific portfolio given your particular unique situation. If you've got a good financial advisor who's already doing that for you, great, stick with them. If you don't, or you'd like the second opinion from a good one, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds. There's no commitment to work with these guys. It's just a service they offer to be as helpful as possible to as many people as possible. Lastly, and Katie, I'd love to get your thoughts on this. This video is launching on Tuesday. The following day, Wednesday at 7 p.m. Eastern, 4 p.m. Pacific, I am emceeing a webinar, a free webinar with Ted Oakley of Oxbow Advisors. And as you may remember from his appearance on the channel a little while ago, he just released a book called Second Generation Wealth, which is basically how to teach your child to be financially successful and resilient. He's had a 40+ year career of largely catering to high net worth families and have seen cases where the family did a really good job of transitioning their wealth to the second generation, and the second generation grew it even more. But sadly, he's seen a lot of examples where the family wealth just got frittered away by kids who were just financially immature, or wasteful, just unprepared for that responsibility. And so we're doing this free webinar on how to raise money smart kids. To sign up for that, again, it's totally free. Just go to thoughtfulmoney.com/kids and you can register for it there. But I'm just curious, Katie, I'm sure that's got to be a question that comes up with some of your clientele.
Yeah, for sure. And I think it's modeling good financial behavior, which I can't say I necessarily do for my children. But there's so many great tools. That's just where my head goes to first, is that technology has allowed us to give the young children more like flexibility and insight into their finances. You can give them an allowance through an app, and then they can use that app to buy partial shares of stocks and see them go up and down.
Mhm.
So I think there's great opportunity to use the technology that we now have to help educate the kids.
So I totally agree. And funnily enough, right before we sat down here, Katie, I was rushing back from the bank because my oldest daughter is just post-college, starting off in life. We are helping her get her first car. We told her how much we'd be willing to contribute, but she's got a good chunk of it on her own. And part of this whole process, both learning about how to take out a loan from the bank and how to buy a car and all that type of stuff, was, okay, we're going to build a budget for your life. You're going to have this car payment. You're going to, this is how much it's going to be. If you only make this amount, compounding is going to work against you. It's going to take you forever to pay off this car. So you want to make sure you're putting at least X away every month. We just set her up as we got the loan with automated payments. So, she's going to be paying that insurance payment, that car payment, every time, the same time of the month. So she's got to know, calendar reminder, okay, I got to make sure there's enough money in the account. So to your point, there is a lot of technology that we can use to really help the kids stay on track here and get educated about this stuff early
Yeah,
on.
and there's nothing that can replace a good old-fashioned Excel spreadsheet to that end. So
Mhm.
I think it's a great place to start. My stepfather told me, he said, if you just can sock away 10% of your salary every year and save that, he said, just you'll see the benefits very long term. And I thought that was at times impossible, but really very sage advice. And that hasn't changed as much as we have different opportunities to use these tools, that the good old fashioned advice hasn't changed.
Exactly. The good old-fashioned fundamentals haven't changed. We're hopefully just making it easier for kids to take action based on it. But of course, we got to get them out of the whole digital device distracted world and make
Yes,
them pay
that's a whole
attention.
other, yeah.
It's a whole other thing. Well, look, thank you so much, Katie. Last point is just with your view on the markets, with everything that's going on right now, most of the people who are watching this channel are just regular people. We do have a number of professional investors, but a lot of them are just regular people who are trying to build their wealth prudently. But more importantly, they don't want to lose it to some sort of, big market insult. So, any parting bits of advice to that person?
Yeah, I mean that's why you want to respect the long-term loss of momentum, because you just want to put probabilities in your favor. So when you do have an environment that has lost that momentum, that has lost market participation or breadth, that it is running a little bit hot in terms of market sentiment, that's a higher risk environment. So it'd be more prone to those types of big drawdowns. And that's why we are more defensive right now in our recommendations. But also to look beyond that and say that these usually present great opportunities to add exposure. So as much as there might be some pain to live through, timing, TBD. I think that ultimately is where we can get like the best entries, right? So to put a positive spin on it, I think that's what we'll be out there looking for, is something that's a little bit of a higher probability setup on the long side.
No, that is the fantastic way to conclude this. Katie, can't thank you enough. Really look forward to having you back on the program again
Of
soon.
course. Yeah, same here.
Thanks. And everybody else, thanks so much for watching.